want to be risk aware. We want to pay attention to what's going on. We want to manage that risk. And we also want to be in a position to take advantage and capitalize on opportunities. So that's what our process is about. That's what technical analysis and relative strength work is about. That's also what being aware of the market cycles is all about. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. It's Friday. We're back. Healthy week in the markets. Things have been looking pretty good out there and moving in the right direction, generally speaking. But how you doing over there? What's going on, Greg? You had a good long weekend?
Good long weekend. Weather's good. Markets are humming along nicely. I think the Dow hit another all-time high yesterday, so things are moving along there. And then, as you well know, Will, probably better than anyone, we're right in the throes of NBA, NHL playoffs. Keely must be excited being a Montreal Canadiens fan, so I'm sure lots of excitement going on in your house right now.
Yeah. We've been watching the games. And the kids have been converted from Toronto Maple Leafs to Montreal Canadiens fans, so they've got the gear and the T-shirts and all that stuff. I'm watching. I'm cheering for them. It's the last Canadian team in the mix. You got to be nice if it was the Leafs, but I think that's maybe wishful or delusional thinking.
Doesn't seem like that's going to happen anytime soon. So yeah, them being the last Canadian team in the playoffs, I think we can give everyone a pass for cheering for them. I don't think we'll fret too much about that.
Leafs have a long way to go. So no, they're doing well. It's good to see they're moving in the right direction. We got nice summer weather. It was like long weekend. It was like we were in the middle of summer for a couple days there. It's got cooled off, but it's nice to have that summer weather coming back.
I think so last weekend I was we were in the 30s, and then I think this weekend it's like in the mid-teens and rain. But I think after this, I feel like I've been saying that for a little bit while. I think we're getting into the nice weather, but who knows?
Oh yeah. All right. Well, looking forward to getting into this, and we want to sort of build off what we talked about last week. We were looking at some of the big picture, historical, macro ideas, and we wanted to talk a little bit more about market cycles and positioning and why that matters, and positioning over prediction, and how these longer term cycles and patterns and trends tend to play out. So looking forward to talking about that, looking at the markets, how we can apply that into portfolios and strategy and getting into things here today.
Yeah, and to your point, well, we've introduced this topic over the last few weeks. We talked about kind of the AI boom, the technology boom, kind of transitioning into the commodity super cycle. And I think what's most important is really we want to understand why it's important to maybe focus more on longer term positioning as opposed to shorter term prediction. So I guess as a starting point, Will, why is it important to kind of look at these bigger cycles and look at where we want to be positioned in the longer term as opposed to maybe day-to-day movements?
Well, markets move in cycles, and there's all sorts of cycles, and there are shorter term cycles, longer term, medium, everything in between, and all different parts of the markets, the economy, sectors. Everything is going to go through these patterns that will move in a pretty consistent trend overall. And so it's driven, by things like earnings and interest rates and inflation and valuations and credit and investor sentiment and market leadership. But they're always changing, always shifting and adjusting. And I think it's important because we can't, and really no one can know the future. My crystal ball is no clearer than the next person's. And a lot of times when you listen to market commentary and strategy, there's a lot of predicting and focus on the future in terms of knowing or predicting what's going to happen. But what we try to do with our approach, whether it's through technical analysis or relative strength or even looking at these cycles and patterns and trends and markets, is to not so much predict, but just look at, all right, what's the current environment? What's the situation we're in now? where are we in the cycle? Where are we in this pattern, and position and govern ourselves accordingly. So we're not working to try to predict every market turn perfectly. We want to understand the environment, recognize when risk and opportunity are changing, and position portfolios accordingly.
And does that lend itself well to our process using technical analysis, trying to see what's going on, kind of big picture, and then distilling that down? Are the two related to one another?
For sure. I mean, it's cycles are really about, okay, and these patterns are about, well, when do things seem like they're overextended, or when do they seem like they're oversold, or when is there too much greed and optimism out there in the market, or when is there a ton of pessimism and negativity out there in the market. So the ideas translate well. I mean, they're somewhat different questions, because one is based in, when you look at some of the cycles and patterns and history, is a little bit more, okay, where are we at in where are we at in the cycle? What's the positioning? The technical analysis tends to look at, okay, well, what's the evidence, and what's actually working, and what's the market telling us right now. But the ideas translate very well and work well together, and help just help our thinking, and help us govern portfolios accordingly.
And like looking where we're at in the cycle, looking at our technical analysis, does that just enhance the probability when we're making trades or decision in client accounts and in portfolios overall?
Yeah, I think what a lot of what we're working to do is increase the odds of success, increase the probabilities that we're in the right position, the right sectors and areas and spots in the market overall. And so looking at cycles and the ups and downs, and looking at patterns and relative strength and long-term analysis, technical analysis, really helps us understand where we're at today, based on, yes, cycles, but also the evidence, and listening to the heartbeat, essentially, of the market overall.
So, given all that, tough question I'm going to throw at you, but given everything that you're looking at and seeing and talking about market cycles, where would you say we're at right now in terms of the cycle?
Yeah, so that kind of builds on what we talked about last week. I mean, I do still think the market is constructive, but it's very much a maturing bull market. And so, since going way back, 08, 08, 09, or depending on how you look at things, and when the last major corrections were, there's still opportunity, there's still growth. Markets have been resilient, but it's very much a maturing bull market. So maybe this is not the bottom of the ninth inning, but perhaps it's the seventh or eighth inning in the bull market, and it's getting to later stages. And you can look at that. Even looking at where we came out of the last like 2020 as example, or even since 2022, or shorter term periods, looking at it from, let's say, the tariff crash that happened, looking at that pattern and cycle. I think things are getting later in the stage. That doesn't mean that markets are going to crash or correct or go backwards tomorrow or anything like that. They're still very much supported by a lot of very resilient fundamental conditions and positive long-term themes. But it's definitely, we're not in a oversold, washed out market overall, where you look and there's value everywhere and things are beat up. It's parts of the market are certainly getting pretty extended. And it's something that, from a bigger picture, we're working to manage and pay attention to, and position portfolios accordingly.
Well, one of the interesting things about this cycle that we're seeing, maybe compared to other cycles, is that, to your point, Will, yes, technology, the markets are getting a little bit overextended, but it's being supported by earnings, growth, like really strong fundamentals, which is maybe a key difference from some of the other technology cycles that we've seen, most notably kind of dot com, late 90s themes there.
Yeah, there's still a lot supporting this and a lot that's helping lift things. So the market still very much deserves participation, and you want to be invested, you want to be involved in it. But I think what we're working to be is a little bit more selective and manage risks, and that's why we're not sitting there all in or either all in or all out of the market. We have a little bit more of a balanced approach. We've got higher than normal cash balances. We've been playing defense for the last while in the last several months and focusing on being in the right areas, right sectors, and also focusing and working to manage risk overall.
Yeah, so being in the right areas, well, being in the right sectors, that allows us to maybe, if we're in the right areas, we can have a little bit more cash. You don't need to necessarily be fully invested, which helps us manage risks, helps us manage volatility. So even though we're not maybe 100% fully invested, we're still participating, we're still getting that lift because, to your point, we are in the right areas that are showing strength and leadership.
Yeah, and we do have probably on average. I mean, there's differences in the portfolios, but I want to say probably somewhere 30-40% just fixed income, non-market type of investments. So not sitting there at 100% invested. Actually, some of that positioning still is hard assets and commodities for the non-market positions. So it's probably a little bit higher than that overall. But the liquidity is not, you don't want fear to dominate. The liquidity is really there to give us flexibility. It helps us manage volatility. It just gives us that optionality for when opportunities appear. So it's much more of a tool, not somewhere that we're long term necessarily wanting to sit there forever, but just gives us some optionality to better manage risks and better take advantage of opportunities.
And does knowing kind of where we're at in the cycle just help us govern and manage the portfolio? As an example, right now there's a lot of optimism, there's maybe a little bit of greed. Does that help us when we see that say, okay, you know what, we see what's going on, we want to just pull back a little bit?
Just you want to be aware, right? I think it's just getting later and later in this cycle. It's not the early innings. We didn't just, I mean, yes, there was a sell-off in March that happened in markets, but I probably wouldn't characterize that as a structural type of sell-off. It was a shorter term shift and pullback that happened in markets, and markets have since reset from there. It wasn't as extreme as we've seen from a lot of other market events, whether it was uh, 2025, the tariff crash, 2022, inflation and interest rates, or COVID more recently was a relatively minor one. And you've seen markets just move up and move in the right direction since then. So I would just say that from a much bigger picture, it is getting to the later stages of this. But as we've also said, there's transitions that happen in terms of the trends and markets and where things are going overall. And I think the market will watch those trends and look at where we're at in terms of patterns. We're seeing new leadership start to emerge and other areas of the market start to emerge with a lot more strength, which is something we're certainly paying attention to and continue to position and reposition accordingly.
Yeah, so given that we're in the later stages of this cycle, given everything that's going on, what would be kind of the main message to clients, to investors, given that markets are at an all-time high? We're probably in the later stages of the cycle. Obviously, no one knows when. What would be your messaging?
Yeah, I think again, we stick with the process here, right? It's working. Markets are still healthy. They're moving in the right direction, generally speaking. And our process, our strategy is designed to navigate through this and steer through this, and has done and is doing a very good job of managing the risk and also capturing the upside and the opportunity. So having that sense of where the longer term cycles are. Remember that's kind of like, I don't know if I drew this out yet, but they tend to go like this. The trend still over the long run is upwards, but when you've had a longer term pattern where it just seems to kind of trend up and keeps moving up, up and to the right with no major corrections, the optimism, the enthusiasm keeps going up. I do think now when we sort of say seventh or eighth inning with a lot of this stuff, there still is a healthy degree of skepticism in the markets overall. That it's not like totally unhinged optimism that's happening. I think even the correction you had this year helped with that a little bit. When you were looking January, February, early in the year, there was a lot more sort of unchecked optimism in markets, and a number of areas got pretty healthy corrections in March. So that part of it is good, at least in the shorter and medium term, which is why we're seeing things continue to move their way up. I just think we want to be risk aware. We want to pay attention to what's going on. We want to manage that risk. And we also want to be in a position to take advantage and capitalize on opportunities. So that's what our process is about. That's what technical analysis and relative strength work is about. That's also what being aware of the market cycles is all about.
Yeah, and as you mentioned, Will, as part of our strategy now, risk is maybe a little bit heightened than it has been at different times. That's why we have a little bit more cash, but that cash is not meant to be there forever. It's meant to allow us to be opportunistic once we see opportunities arise. So we have that ability to be flexible and nimble based on changing market conditions.
Yeah, and that's what it's all about. So it's just sort of the cycles and the patterns are just a different way from a bigger picture to look at this, and that's why we brought up the historical patterns last week. And just I don't think market wise, when you compare where you were, say 99, 2000 in technology, that we're at that point yet. But when you stretch out, say over the last 15, 16, 17 years or so, it has been a very nice run, and it's been a very, very good time to be invested overall. So it's just part of our process is really about being risk aware, paying attention to what's happening out there and shifting and adjusting accordingly. So it's really, at the end of the day, we want to manage that risk. We want to help drive performance. That's because we want you to be wealthy. We want things moving in the right direction for you in terms of the portfolio. We want you to feel wealthy. We want you enjoying life, enjoying retirement, enjoying your wealth, and we want you to realize your wealth. That's what Aretec Wealth is all about. That's what we're here for. We'll be back with everybody next week.